Hey, what's going on everyone? Steve here with IBC Global. So in today's video, you are going to see a presentation that I recently put together for a client, someone that we're working with right now. He's in the process. He just signed an application and he's going through underwriting. But what we spent a lot of time on was finding the right policy. What I should say is finding the right amount to pay into his policy. He's interested in a larger policy. He was considering funding a policy with $100,000 per year for 5 years, which is $500,000, or $200,000 per year for 5 years, which is a total of $1 million. He's looking at both options. He thinks he can go with the $200K option, but the main question to answer was this: what happens if I go with the $200K per year option and I'm not able to get $200K in, meaning I bit off more than I can chew? So that's what you're going to see covered in this presentation. You'll also see my recommendation. Let us know your thoughts as you watch it. Please leave a comment below or leave any questions below as well. I would be really interested in seeing them. And as always, I hope this helps. Thanks so much. In this video, I am going to provide an overview of the attachments. I'll hit on the detailed illustration first. This is one of them. And then also the Excel workbook, just providing a quick recap of the different tabs and what I put together. So what I will begin with is the detailed illustration. You'll see the zip folder with several of these, which include the different illustrations we put together. But the main page to look at when you're looking at one of these illustrations is the last section, the ledger statement. This gives you a nice breakdown as to where the money is going. The supplemental numeric tab is nice as well because that does display the guaranteed values based on the specific funding scenario we put together. In this illustration, the scenario is $200K per year for 5 years. So if we go to the ledger statement, here's the main thing to look at. One, to know if the policy is set up correctly. And then two, how flexible is it with respect to $200K per year is illustrated, but are you actually committed to that? The answer is no. So here's what we've got. $200K per year is going in for 5 years, but up here, this guy is your true minimum premium. $18,000 and change. Where we came up with that oddball number is based on the limits within Guardian's illustration software. So with the exception of the first year, because Guardian will allow a large one-time lump sum, it can be up to 50 times the base premium. With the exception of that, the most we can illustrate going into PUAs every year is 10x whatever the base premium is. So really what we'll do to juice the cash value is take the total desired payment one has, in your case, $200,000 per year, divide it by 11, and that gives us the minimum premium. So the true minimum commitment, like what will you be billed for every year? It'll be approximately $20,000. So if we look at this illustration, we've got $200K per year going in, and we've got a PUA rider of $181,000 and change. That PUA payment, particularly a scheduled PUA payment, first covers the cost of a term insurance rider, and then everything above that goes into PUAs. So how I would set it up is like this. I would set the scheduled PUA rider at, call it about $2,000. Actually, I wouldn't do that. I'd set it at about $1,800. A little bit more, about $1,820. What I'm aiming for is the base premium plus a scheduled PUA rider to give you a clean bill of $20,000 per year. That $1,800 PUA payment will first cover the cost of the term, and then everything above the cost of the term goes into PUAs. Then everything else, call it an additional $180,000, could go into an unscheduled PUA payment, which is literally you logging onto an online account or through your mobile app and just sending money right into your policy. It's extremely flexible and you have full control of that. You're also not required to pay the $200K every year. You might end up paying less. You might end up paying less if you decide to do so. But with all that said, this illustration displays funding it for 5 years and then not a penny thereafter. You can continue to fund it, especially if you wanted to continue to pay the minimum premium or something like that. You've got a lot of flexibility. Main thing to look for when examining the cash value to see if it's set up correctly, break-even point with this product and PUA rider typically falls between years 3 and 4 if you are max funding it. I know we hit on that a bit yesterday, and I'll go through the Excel workbook right now displaying the same thing. But the illustration, that's what to look for. And the main takeaway, if you like the idea of committing to the minimum, is I would schedule an amount of $20,000. You could pay that annually and then just pour in excess funds at your discretion. But the amount you would be billed for would be that $20,000 minimum premium each year. So in the Excel workbook, you'll see a number of tabs. These are what we had reviewed yesterday, just looks a bit cleaner. Tab 1, 200K policy funding assumptions. So this displays the policy, or I should say the illustration we just looked at. In fact, here's the exact one, 200K per year for 5 years. These cash value and death benefit figures will be identical to that illustration. But then to the right, again, the exact same policy, but showing what the policy may look like if you don't fund 200K per year for 5 years. For example, what happens if you get 200K in, you max fund it for years 1 and 2, and then only pay 100K in for the next 3 years? Scenario to the right, what if you get 200K in years 1 and 2, and then paid 100K per year into it until year 8? And why I made it year 8 was to get the same $1 million into the policy. So if you look at that 1 million and you said, I like that target amount. Let's say something happens and I can't get the full 200 in every year, but I can get 100 in on average every year and it takes me a little bit longer. That's perfectly fine. You could do that. It could even be 50K per year. Same is true if year 2 you wanted to pay a lower amount, you could easily do that. The one thing I'll add, if you're able to max fund it at 200K, 10xing the base premium and right up to the MEC limit for the first 2 years, that's going to give you that break-even point of year 4. That would even be the case if you paid 0, not even the minimum premium beginning year 3, or you'd be really, really close in year 4. I can run the exact numbers, but the first 2 years, if you're able to max fund it both years, how I like to phrase it is that you put yourself in a position really where you can't lose, where we see the policy perform, deliver a strong internal rate of return, and people look at it, they see the early break-even point, so they see the value sooner where they are adding money and it's compounding for them earlier, and it results in satisfied policyholders. Let's put it that way. But this displays the different funding assumptions. Tab 2, we've got 200K or 100K MEC limit. Per our call yesterday, you had mentioned that the 200K option is probably the one. This just displays the two side by side. And the most important piece to look at here is first the 200K policy. You've got the minimum of 20, but then here in the middle, you've got the exact same policy with the minimum commitment of 20, same death benefit of 3.15 million, but what it looks like if you only paid in 100K per year. Compared to this guy, the 100K per year for 5 years with a minimum of 10. So this would make sense if you knew that you were only going to pay 100K per year into the policy and never go higher than that. Where you would wish you would have this is if we went with this option, the 200K per year one, but the maximum you only that you got into the policy on any given year is $100,000. That's where we would look at it and say, man, I wish I would have went with the 100K option. But per our call and such, seemed like the 200K option is more than doable. You can start out with 200K right out of the gates, so it'll work out quite nicely in that respect. Then the 5 or 10% PUA fee. This just gives you a side-by-side of what we had reviewed. Let me get myself out of the way. So what I mean when I say that, regarding what we had reviewed, you've got the 5% PUA fee, and then the 10% PUA fee, exact same product, but different riders attached. And based on the guarantees, the 5% will be the winner from start to finish. For example, or what illustrates that, I should say, this column, cash value difference, displays how much more or how much less you have in cash value with the 10% PUA fee directly compared to the 5% PUA fee. And based on the guaranteed values, it's less all the way down. and you'll see this on the illustrations as well. The design is identical. The only difference is that PUA fee. Non-guaranteed values, a little bit different story. For the first 10 years, you've got more at the 5%. From that point forward, you do have significantly more potential with that 10% PUA fee. But I do like to use the word potential as it is non-guaranteed. And just in our experience, when we've examined historical Guardian policies, it's only been with the 5% PUA fee, because the 10% PUA fee with them is relatively new, but it was introduced as a means to generate greater long-term potential, really to put their illustrations on par with some other carriers. That's what it seemed like they had done there. And then the last tab is the loan workbook, which does not display an illustration, a exact loan illustration with Guardian, but it's a nice workbook that can give you a quick on-the-fly figure of what the policy is performing, what the policy performance looks like compared to loan interest you're paying and such. The loan workbook, this was designed really to mimic cash value collateral loans, which is that line of credit, taking a policy to a bank, assigning the cash value to them as a line of credit. It's really designed to mimic that. But as we look at it, it's fairly straightforward. So you can plug any of the illustrations in here. I would just drop the outlay, cash value, and death benefit figures in under the policy value section. And then these three will automatically update for you. This gives you your annual internal rate of return. So you can see the net growth rate on your policy year over year. And this is an effective tax-free return as well, assuming we don't trigger a MEC, and also assuming we don't lapse the policy or cash it out with a gain. There are things that can trigger a taxable event, but if we do things right, we can look at that as a tax-free IRR. Then we've got the yearly cash value growth, which isolates what the policy is growing by year over year net, and then the total gain on cash value, which is pretty straightforward. If you look at 870, total input is $1 million. Cash value is $1,950,000. So everything above your payment of $1 million is the total gain there. Then as we look at the cash value collateral loan section, you've got the LTV at 95%. That displays the maximum loan you'll usually be able to take. So it's going to be 95% of whatever the cash value is. The loan interest rate with your Guardian policy is 5% fixed. However, if you have a loan outstanding and you are paying the loan interest annually, you will see a discounted rate of 4.76%. So let's assume you've got an opportunity for $500,000 in year 3. You decide to borrow against it. Here you go, $500,000 loan. We punched that in at 4.76%. There's the annual interest, $23,800. Here's what real estate investors ask. How much did I pay in loan interest? And what did the policy grow by that year? This way you can compare it year over year. So we've got the rate. We see that the cost to borrow is higher than what the policy is growing by in year 3. And this could be different, especially it will be different if you're using a cash value collateral loan. But let's just leave it as is for now. Let's do this. So let's assume you take a $500K loan and you begin to repay it in year 6 after you've funded the policy. And to make this fun, let's say you take another loan for $450,000 in year 5. So you've taken loans for a total of $950,000. Annual interest payments. But let's look at this to the right. Through year 5, the annual interest you are paying is well above the interest you're receiving. Then looking at the total gain on cash value, we like to compare this with the total interest we've paid over time. So let's assume you begin to repay it. You can repay it however you'd like. Let's just make it simple at $100K per year. And we'll punch in 50 in the last year. And these are principal payments. And this assumes you're paying interest at the same time. So what we've got when it's all said and done is as follows. Where is it? Right here in this particular example, which is year 7, when the yearly cash value growth is exceeding the yearly interest payments. And if we look at this, it's at year 10, when the total gain on cash value has exceeded the total amount of interest we've paid. This will change depending on how much you borrow and then how quickly you repay that loan. The death benefit with loan just displays the net death benefit that will be paid out when you have a loan outstanding. And again, this specific workbook is meant to mimic a cash value collateral loan, not a direct policy loan. But it's a cool workbook as you can play around with different scenarios and really measure how much you're paying in loan interest compared to what the gains are on the policy. If you look at a cash value collateral loan, which may have a higher interest rate right now, 6%, you can increase the interest rate if you'd like. But it's pretty neat how we can just get a quick snapshot of the interest compared to the gains. So I hope this is helpful from an informational standpoint. Let me know if you have any questions at all, and I'm looking forward to working with you in the years to come. Have a great day. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.